Our financial markets are having their worst performance since the 2008 financial crisis. The S&P is having its worst performance in a decade, having already dipped by 5%. The Europe 600 index has dropped by 5.9%, while the MSCI Asia Pacific Index sank by 4.1%. This is even worse than the 2010 flash crash. We're seeing an unprecedented drop in market values. The question is, what will happen to the stock market next? Will we see a bounce, or will the markets continue plummeting? It's been quite a dramatic week overall. Saudi Arabia decided to flood the market with cheap oil in an attempt to crush their oil competitors in the global market. This has led to disagreements in the Organization of Petroleum Exporting Countries, or OPEC, and the market has reacted in a very aggressive way. The price of oil has fallen by 30% to a 5-year low. Brent oil has fallen to $33, and Bloomberg has called this one of the most dramatic bouts of selling ever. This has turned out to be the biggest single-day drop in oil prices in history. The OPEC has failed to reach an output agreement deal, and there is a possibility that this group, led by Russia and Saudi Arabia, will collapse as a result of these disagreements. Russia is refusing to bend to Saudi Arabia's wishes for a further reduction in output of 2.1 million barrels per day. This will not continue past the end of this month, which will allow them to pump as much oil as they wish. An oil market crash is dangerously close to becoming a reality. And if it happens in the midst of a stock market crash, the uncontrolled production will make the oil prices drop further. U.S. oil companies will suffer the most from this oil market sell-off. Many of these companies have been taking out loans to drill American oil, with the aim of selling it on the international market. With the current prices this low and drilling costs this high, it's no wonder the oil companies are finding it so difficult to maintain operations. It wouldn't be at all surprising if some of these companies file for bankruptcy or shut down portions of their operations. Shares across the oil exploration and production sector have fallen to near all-time lows. This is due to the declining oil prices that have substantially reduced revenues for these companies, not to mention the high levels of debt they've accumulated. Investor sentiment remains poor, as many fear that the current stock market drop will become even worse. With the future of the OPEC partnership remaining uncertain, and with global financial markets tanking, the volatility of U.S. oil has skyrocketed to the highest level in 5 years. Gold and other commodities have also been affected by this collapse of oil prices. Fund managers who have incurred losses from oil will have to liquidate some of their positions on gold as a way of covering the losses. This price war in the crude market by major oil-producing nations has affected the financial markets as a whole, and this is causing wild and unpredictable investment moves in many areas. Some of the exchange-traded funds that track U.S. markets have posted major declines. At the same time, the United States 10-year Treasury yields have fallen to 0.5%, and 30-year Treasury bonds have dropped to 0.9%. As a result, the United States yield curve is below 1% for the first time in history. This yield curve indicates that the U.S. economy is experiencing a historic slowdown. It may be only a matter of time before we find ourselves in the middle of an economic meltdown. The European 600 index has fallen to historic lows. More and more analysts appear to have a bearish outlook for the near future, and economists are predicting that the Euro index will continue plummeting, just like the U.S. indexes. Indexes that track economic performance in other geographical regions are also in bear territory. Exchange rates have seen sharp moves as well, and traders are struggling to estimate where the trading ranges will be because the market is too volatile. The Japanese yen went up by 3% against the dollar, while the Swiss franc and the euro also strengthened by over 1%. The spread between Italy's 10-year yield and Germany's jumped up 33 basis points to 211, the highest since August. If this crash in oil prices continues, many countries will face dire political and economic challenges. Oil exporters will experience a decline in GDP, and many central banks will be under pressure to avert an economic meltdown at all costs. The market is simply too volatile, and Asian countries like Japan and South Korea are sounding their alarms due to this rapid movement in prices of various assets. Sarah Hunter, chief economist for BIS Oxford Economics, had this to say recently on Bloomberg TV. "You just don't know which way things are going to go. It makes it very hard to price anything right now. We're seeing that in the market with the wild oscillations that are coming through." The markets are simply too erratic and chaotic. Wall Street seems to more closely represent a high-risk casino than an epicenter of global investment. Meanwhile, Main Street remains buried in debt. The United States economy continues to perform poorly as these troubling new developments in the stock market bring us closer and closer to the brink of collapse. The American economy is extremely vulnerable at the moment, as hundreds of companies are underperforming and their stocks have been overvalued. Much of this decline in performance is due to the current disruption of the global supply chains. In the last 2 months, many of these supply chains have been suspended, thus reducing global trade across the board. As a result, companies have experienced a sizable drop in cash flow and income. This is happening as most companies have huge debts, just like the American economy itself, which is debt-driven. It seems that a financial crisis lies ahead of us, and it has already begun to show in the stock and oil markets. Numerous investors are pulling their money out of the stock market because of this panic. Rates are soaring and ultra bond futures are up, while the 10-year yields are at a near record low of 0.5%. Germany's 10-year yield has also decreased by a whopping 14 basis points to a return of 10.85%. The Japanese 10-year yield has also dropped by 4 basis points to negative 0.163%. It is very clear that the global economy is slipping further and further. The imminent collapse of the financial markets is threatening the stability of the global economy. In order to stabilize these turbulent markets, the Federal Reserve will not only need to cut interest rates further, but they will also have to start a new round of quantitative easing. The current struggle in the stock market will continue until policymakers get ahead of the curve and employ these strategies. If the Federal Reserve doesn't act in time, we could very well find ourselves in another Great Depression. This is shaping up to be a year of reckoning. Market bubbles are beginning to burst. We have already accumulated the highest amount of debt in history, both in the private and the public sector, reaching a staggering total of $75 trillion. This is about 5 times more debt than we had just a few short decades ago. The Federal Reserve may not be able to pull off another quick recovery this time. The United States economy has been fueled by debt for years, but we are at the point where this is unsustainable, regardless of the efforts that the Fed is making to prevent a collapse. The stock market is already plummeting, and wealth worth billions is being lost every day. The joyride we have had in the stock market for the last 20 years appears to be coming to an end, and the stock market could collapse to a degree never seen before. The oil market also remains uncertain, and there is a very high likelihood that the prices will continue falling. This will likely cause many oil companies to go bankrupt, especially the ones that took on huge debts to finance their operations. The fallout in oil prices means that other global markets will also be shaken. Unless the Federal Reserve comes up with a lasting alternative, the whole economy will collapse, and we will find ourselves in a global financial meltdown that will make the 2008 financial crisis look like nothing.